Hey everyone, it's Mitch. So it's tax time here in the US. So in this video, what I want to cover off on is really two things. One, what are your chances of getting audited? And secondly, what are some triggering events that could potentially make you more susceptible to an audit? So all the information that is contained in this video can be derived from the IRS website and other credible tax resources, though it does take a fair bit of digging. Before I get too far into it, don't forget to like and subscribe. I cover off on a lot of topics related to personal finance and investing. So without further ado, let's get into it. So firstly, let's talk about what are your chances of getting audited. So as you can imagine, right, the higher your income, the higher your likelihood of potentially getting audited. I mean, think about it, right? The IRS is fairly depleted when it comes to resources, right? So they cannot take all of their energy and try to audit, majority of the tax filings that are basically submitted to them. So they have a tendency of focusing more on higher income tax filers, and that's for a variety of reasons. One, those are the bigger fish, right? So if you have an error on a bigger tax filing, it's probably more lucrative for the IRS than going after smaller filers. And the second reason why they typically do this is that the higher net worth or the higher income types of tax filers, they usually have more complicated types of tax returns. When you have more complicated type of tax returns, it generally creates more opportunities for potential errors to be on there. So it's just a better return on invested time for the IRS to go after the bigger fish in the pond. The second thing to note here is that, of course, if you have a business, so you're a Schedule C filer, right? You're filing your individual tax return, but you're also including the Schedule C appendix to it, that almost automatically increases your likelihood of getting audited quite significantly. So what does the data show? Well, the data shows that last year, 0.4% of filed returns were actually audited. Of those 0.4%, about 20% did not require a correction or a recommendation by the IRS, and 80% of them actually did require some type of correction, and the recommendation from the IRS was an incremental $7 billion that needed to get remitted to the IRS. Now, a key thing to note here, okay, is that even though I'm saying this number of 0.4%, it doesn't sound like a whole lot, right? But the fact of the matter is this, right, that the year prior, so back in 2018, the number was only 0.15%, okay? So we're talking about almost a threefold increase in the number of returns that were actually audited, okay? And now we're also hearing about the Biden administration looking to invest another $80 billion or so in the IRS to basically derive an incrementally higher return on their investment. They're trying to get about like $700 billion in incremental IRS recommendations from a tax return perspective, okay? So we can kind of like assume that perhaps the number of tax returns that get audited is perhaps going to quite significantly increase as well. Now, one thing to note here is that this $80 billion is, of course, a proposal. We don't expect that entire amount to get through. But with that said, some variant of it has a high likelihood of getting through. And if that is in fact the case, the probability of getting audited also obviously does go up. So what about by income? So let's start off with the higher numbers and then let's keep moving down. So for earners making over $1 million, 2.4% of returns were audited. For earners making between $200,000 and $1 million and did not have a business, 0.4% of those returns were audited. But if you did have a business and are in the range, then 1% of returns were audited. For earners making less than $200,000 and no business, the examined number was 0.1% and increases to approximately 0.8% if you did have a business. So you can see from those numbers how much more significant a Schedule C filer is relative to somebody who does not have any business-related income or losses associated with their tax return. So then let's cover off on the second question, right? So what are some of the triggering events that could potentially make you more susceptible to an audit? So one of these things that we've already talked about, right? So if you're a Schedule C filer and you have business-related income or losses, and that is getting filed with the IRS, it automatically puts you in the bucket of higher audit risk, okay? And more specifically, it makes you almost 3 to 4 times more likely to be audited. The other thing to note here is that the IRS, of course, uses computers, right? They use computers in terms of determining which returns they actually want to audit. I mean, think about it, right? When you have hundreds of millions of tax filings that are coming in on an annual basis, they're not going to be able to go through it or sift through it. So they use computers to basically do some type of data analytics on the returns that are actually filed. And based on those analytics that are performed, which is largely based on various ratios, it's based on some entry points which the IRS is already aware of, it basically flags tax returns which are potentially in error. So as an example, right, another triggering event that could potentially result in an audit is if you have unsupported income. So all of those filings that you receive on an annual basis, your W-2s, your 1099s, whatever they might be, a copy of them is sent to you, but a copy is also sent to the IRS. So the IRS, of course, has all of those records on file. Now they're receiving a tax filing that basically has a mismatch against what they already show, then that of course has a higher likelihood of triggering an audit. I did say earlier in this video that if you are making a higher income, right? So we all know that the Biden administration basically considers $400,000 to be considered a pretty high income, okay? So that can be used as a gauge, but typically when it comes to the IRS, you see a significant increase in the auditability once you start hitting around the $200,000 number. Then there's also investments, okay? So I'm not talking about your typical stocks, bonds type of investments. I'm not talking about your 401k, your retirement accounts. Those are pretty straightforward stuff. That's not what the IRS is more specifically interested in, but they are interested in other types of investment income, okay? So for example, if you have property, real estate type of investments, if you have like a Schedule K or a partnership type of filing, all of those types of things definitely puts you into a higher risk of potentially getting audited. The other factor that can get you audited as well is charitable contributions, right? So if you have a significant amount of charitable contributions relative to your income level, it potentially puts you into a higher degree of an audit as well. So for example, if you're somebody who's making $20,000 a year and is showing like $5,000 or $10,000 in charitable contributions, the ratio doesn't make a lot of sense, right? And that could potentially put you into a higher degree of an audit. Now, of course, if you're somebody, who makes like $1 million a year or $2 million a year and is submitting $25,000 towards charitable contributions, that is less significant of a deal, and the ratio is kind of like makes more sense. And of course, the other reason why you can potentially get audited is just doing dumb stuff, right? So if you have a math error or a clerical error in your filings, now most people, of course, they use, some type of a tax software, and that eliminates a significant component of this risk. If you have math or clerical type of issues, you have some percentage that was erroneously calculated, that sort of thing. So basically stuff that I call dumb stuff, that essentially puts you into a higher risk of an audit as well. So in my view, the IRS audits absolutely serves a significant purpose, okay? It's absolutely needed, but with that said, right, it doesn't mean that you need to be scared of an audit. It's just a matter of ensuring that you have the appropriate records to basically support any of the claims that you're making, right? So if you're a Schedule C filer, and if you have significant expenses, say you're a startup or somebody who's just basically, getting going on their businesses, if you will, they may have a higher expense ratio than somebody else. But with that said, just make sure that you have the appropriate records for it, and you should be okay as long as you submit that to the IRS. Similarly, when it comes to charitable contributions, right? Charitable giving is absolutely a great thing for society as a whole. So as long as you have the appropriate documentation to evidence those claims that are basically being made, that absolutely puts you in fair standing with an audit, right? So the intent of this video is primarily to inform and to give you some guidance in terms of which way the IRS is directionally headed. I hope you enjoyed the contents of this video. Don't forget to like and subscribe, and I'll see you in the next one.